Hello and welcome. I'm RealCrowd CEO Adam Hooper, and this is the Real Estate Investing for Your Future podcast. Here we explore the latest in commercial real estate trends, insights, and investment strategies that passive investors can use to build real estate portfolios that last.
All opinions expressed by Adam, Tyler, and podcast guests are solely their own opinions and do not reflect the opinion of RealCrowd. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. To gain a better understanding of the risks associated with commercial real estate investing, please consult your advisors.
Our guest today is Jon Venetos, founder and CEO at LURIN. In today's conversation, Jon discusses his transition from the hedge fund world to real estate, his approach to hedging rising interest rates, and what he looks for in a multifamily market. Be sure to check the show notes for links to learn more about Jon and what he's up to at LURIN. We hope you enjoyed today's episode with Jon Venetos. Well, Jon, thank you so much for jumping on the show today. We've worked with you guys for a number of years, and we appreciate you taking the time to talk to our listeners a little bit about LURIN and your take on the current real estate market. So why don't we jump in and tell us a little bit about what you guys are up to at LURIN and how you got into the real estate space.
Sure. Yeah, so we started LURIN in 2016. I spent the first part of my career, not in real estate, but actually in finance. Specifically, the last 10 years at a large multi-strategy hedge fund called Citadel, where I ran a business and focused on fundamental equities. And so it's a bit of a pivot to end up in real estate today. And I got to that position because my family's been in the multifamily real estate business for 60 years. And so I grew up around that and was afforded the opportunity of kind of seeing my family build their real estate business, and was pretty interested in it, and actually felt like 25 years in finance was, I'd accomplished a lot of the things I wanted to accomplish and was looking for a new challenge. And that culminated with kind of starting LURIN initially with the concept of more of a family office, but then really quickly shifted towards focusing purely on real estate, and even within real estate, focusing on distressed and stressed value add opportunities in the multifamily space. And so, from my perspective, when I kind of looked at the opportunity set, I saw a really inefficient market in real estate, and specifically in the multifamily space, and felt like there was a significant amount of what we would define in the fundamental equity business as alpha. And so, the opportunity to extract outsized returns with a relatively manageable amount of risk was far greater in real estate than it was in, say, public equities or other asset classes. So for me, it was a bit of an interest since I was a kid, to also just the investment opportunity set, was one that really resonated with me and kind of demonstrated there were a lot of inefficiencies that could still be, gleaned out of the market.
And I'm curious, what are some of maybe the lessons learned in your career on the hedge fund side of the world that you've carried over into what you're doing with LURIN, and maybe what's different, or what didn't you expect when you made the switch into the real estate space?
That's a really good question, actually, and one that I think is like a cornerstone of what we're trying to do here at LURIN. There were a number of things that I was exposed to during my kind of what I would call first chapter of my career, that are extremely applicable to real estate and candidly just aren't taken advantage of in the real estate space. And a couple of those things, are on the data side. From an analytical perspective, the vast majority of, how people make decisions whether you're talking about setting rents to acquiring properties to understanding the competitive landscape to servicing your residents and your clients, data is just not at the forefront of what people do in the real estate space. And to me, in what I did in my first chapter of my career, that was paramount to what we did. And so we've really tried to kind of take some of those lessons learned and apply them to the hedge fund space, to the real estate space. And I think on top of that, from a capital markets perspective, which is very relevant right now, again, in an industry like real estate, there hasn't been as much focus, in my opinion, as there has been, say, in the hedge fund space on kind of asset liability mismatches and thinking about structuring your investments with more of a capital markets focus than it is purely just I want to buy this apartment complex and I want to do this value add renovation. That's the simple business plan, but then you've got to actually structure the financing around that. And when you look at things like, very relevant today, interest rate caps, something that we were very focused on 2, 3, 4, 5 years ago when we started, was making sure that we, even though we had floating rate debt and rates were going one way, which were lower, that at some point rates were going to go higher. And so we were very focused on capping our interest rate risk. Something I was super surprised to hear was an exception versus a rule. I think a lot of our competitors bought way out of the money interest rate caps that today are getting close to being in the money, but we were fortunate that we bought much tighter strike rate interest rate caps that pretty much locked in our financing over the foreseeable future. Now, it's not in perpetuity because we don't have financing that's in perpetuity, but at least for the term of our investment, we've got a pretty good structure in place in terms of our financing risk. I think that's another example. I think the other piece is just lack of investment in the real estate space in what we call human capital or people operations. And so when you look at again the competitive landscape, just not the same level of investment in the development, education, career progression of individuals in the real estate space like there is in finance or in the hedge fund space. Obviously you hear this term all the time, right? Your single biggest asset in finance is, the people that go up and down the elevators every day. I think that is probably not to the same extent true in real estate, but it's a pretty close second, right? Like you obviously have an asset that's got a value to it. It's got bricks and it's got land value and it's got infrastructure and things associated that create its asset value. But the people, both the people who operate your property, the people who support your properties, the people who reside in your property, the community, are all paramount to the success of that asset. And I think, again, as being an outsider in the first part of my career and then becoming now an insider, it's, one where you look and say, wow, this is a hugely inefficient space. If you invest in your people and you develop them and you think about career progression and their ultimate, sources of success, both monetarily and non-monetarily, like ultimately that's a huge competitive advantage. So I think those are some things that we've tried to glean and apply into the real estate space.
Yeah, and let's maybe take a step back to talk about the interest rate caps. For listeners out there that are relatively new to the space, a lot of us have been used to this environment that's a very low rate environment, right? And as you said, kind of trending downwards. And now we are recording this here in the middle of October. That's absolutely not the case anymore. So maybe talk a little bit more about what does that mean? Interest rate cap, how does that factor into the financing of a property? And then generally, how the financing landscape has changed in the environment today. What are your thoughts there? And we'll maybe ask you to crystal ball a little bit. Where do you see that going?
Yeah, so, there's two ways that you can, generically speaking, there's two ways that you can finance a project. You can do it through floating rate debt or fixed rate debt. The vast majority I would say this cycle has been initially through floating rate debt and then rolling into either a floating or a fixed rate agency product to refinance your asset or dispose of it if you decide to sell it. But I would say a lot of the participants have done floating rate debt, given what you just said, which we've been in a super cycle of monetary easing for the better part of 14 years. And that's created a tailwind in the real estate industry and specifically the multifamily space. And so if you're looking at a fixed rate, it's pretty straightforward, right? You have a fixed rate interest rate that you're paying on a monthly basis. But on the floating side, you're tied to, historically it was LIBOR, and now shifted to SOFR. And you have now exposure to, good and bad, to rates going down and rates going higher. And lenders have, put some interest rate floors in place so that they ultimately have at least a minimum SOFR spread that or SOFR rate that they're gonna capture plus the spread. Mm-hmm. And so all these transactions that you've seen, and again, just focusing in a multifamily space, lenders have required interest rate caps, right? So in essence, you're capping your total interest rate that you have to pay on a specific project. And so when SOFR, for example, started the year at a 0 to 25 basis points, or maybe it was 25 basis points, and today SOFR's 300 basis points, you in theory were, required by the lender to buy an interest rate cap when you close the transaction. So let's just take, for example, you bought a deal last summer. So 2021 in the summer, rates, SOFR was 25 basis points. Fed rates were 0 to 25 basis points. The Fed hadn't started its tightening cycle yet. Inflation was transitory, according to the Fed and Treasury officials. And you went to lender XYZ and you got a loan. And they said at closing, you have to buy a 3-year interest rate cap with a minimum strike of, let's just say, 300 basis points. So you're required to buy a 300 basis point cap. It probably cost you, tens of thousands of dollars. And for 3 years, if interest rates go above 3% and you have your spread that you're paying on top of that, you're not exposed to any further interest rate moves at or above 3%. Mm-hmm. That's what most people did. You can, kind of see why people would do that. It was a relatively de minimis amount of money, tens of thousands of dollars, depending on the loan size you had. What we chose to do was, at that time, we bought 75 basis points or 100 basis points cap and strikes because we viewed the incremental cost of capital as a hedge that we knew that rates were going to go higher at some point during the life of that 3 years that we were going to have our structure in place. And so it cost us, say, like $100,000, while it cost other people tens of thousands of dollars. The difference being we're hedged for all interest rate movements above 75 or 100 basis points. And so, you're just cost of capital. That's all this is, right? It's a simple equation of what's the cost of capital. Now, what also changed when the Fed started raising rates is volatility went higher. So volatility is an input into the calculation of what that interest rate cap hedge costs. Mm-hmm. And so you've had vol go higher and you've had absolute rates go higher, which has made the interest rate cap market super expensive. And so, certain people chose to have wider strikes and certain people chose to have tighter strikes. We happen to be in the tighter strike camp. Mm-hmm. And today, if you ask me, if I was buying a deal today, would I buy an at the money strike or would I buy something further out. I think right now, because this dovetails into like, where are we? We think the terminal rate for where the Fed is going is higher than the 425 to 475 that are currently in the dot pattern. Don't know where that is. I think ultimately rates need to go higher than 5%. Do I think they need to go to 6 or 7? I don't think they do. Do I think the Fed might go there? I think they might. Only because this Fed has been behind the curve on inflation, and they will probably be behind the curve as it relates to the impact on the economy. And obviously, shifts in monetary policy have big delays. Some are instantaneous when you look at your credit card bill. Others take longer to happen. CEO behavior, lending, those take longer. I think the Fed will overshoot, cause a deeper recession. And so I do think we're headed for a recession. I think I just saw a Bloomberg article that said 100% of economists now think we'll be in a recession in 12 months. I think it'll be faster than that, and I think it'll be a bit more protracted than people anticipate.
And now again, kind of stepping back to your foresight in buying those tighter caps, was that to your prior comment around data? How did you come to that determination that the upfront cost of paying more for that lower cap at origination was going to be a good bet?
Yeah, so first the math just showed that the incremental dollars to spend, you were in essence, you weren't getting it for free, but it was pretty close. Vol wasn't pricing in, I'm talking last summer, right? Like last year, the year before that, all the way through the end of the year, you could have bought tight interest rate caps at strikes that were, within 50 or 100 basis points of spot rate SOFR. And so that from a mathematical perspective, most people could have done that. I think the other piece is more of an art than it is a science, which is just that the Fed can't keep rates at zero in perpetuity. There are countries that have had monetary policy that have kept it at zero, but I don't think we want to kind of go down the path of Japan, right? So I would say that's the one country that has systemically, since its biggest recession in the late 80s, early 90s, has systemically kept interest rates at zero. I don't think we want to emulate that monetary policy. So I think from the art perspective, when you look at a 3-year investment or a 5-year investment, and you've got a 3-year, our art structures are 3 years with 2 1-year extensions, so a 5-year total duration. I think it's a pretty good assumption to think that rates may be higher than zero during that 5 years. I'm not trying to be,
when you put it that way.
Yeah, I'm not trying to be, but meaning they could have gone from 0 to 2% back to zero.
Right.
And you look at the terminal value at the end of the 5th year and you're like, oh, you're back at zero. Yes, but you had to sustain a 200 basis point. Now, in this case, we're at 300 plus basis point increase on our way to maybe 425 or 475 or 500 or 550 basis points. So,
It'd be pretty costly.
So anyway, so I think it's it's a bit of art and a bit of science. Like we could look at it and say this is really cheap, and when someone's willing to give let you buy something really cheap that gives you a ton of optionality. Like just to give you context, we have a deal where we paid sub $300,000 for an interest rate cap. It's not really relevant because you don't understand the size of the loan, but today that's worth $4 million. Right, mark to market. Again, everyone's gonna say, well, how much, what's the notional amount of that strike? It's not really relevant. It's more to illustrate the magnitude of something that 6 months later or 9 months later has increased in value because its terminal value is now worth $4 million plus. So, long-winded answer. It's a bit of art and science.
Yeah. And then now, how have you seen those? Again, we're obviously in an inflationary environment. I think there's a lot of investor concern around rising interest rates, around how that's going to impact certainly the multifamily space. how have you guys seen that filter through into your operations, or in terms of just your approach to acquisitions now? Are you net buyers, net sellers? Like, just kind of give us a picture on where you're at generally in terms of the market these days.
Another great question. I mean, I think it's multifaceted, right? So, from an operations perspective, we've seen very little impact on the negative side from rising rates or inflationary pressures. If anything, obviously, shelter and housing has been a big contributor of the inflation numbers, right? So that's been a tailwind for us. And we haven't seen yet any impact from a slowing economy on our residents, meaning less hours worked or layoffs or desire to want to not impair their savings and instead move to a situation where they're trying to become net savers again, meaning downgrade their apartment to a less expensive apartment. We haven't seen any of that. So on the micro level, from an operations perspective, it's been pretty much steady as you go in the markets we're in. Now, again, LURIN is not a beacon or a sample set that represents the entire market. We have very focused exposure. So I would not use this as the index. There are other competitors that have much broader portfolios. We're in a couple handfuls of MSAs, and so I don't think you should extrapolate that statement. I think it's about us, which is it's very idiosyncratic. It's not macro. On the macro side, not on operations, but on the capital market side, it's challenging. Both from an acquisitions perspective, from a dispositions perspective, from a refinancing perspective, it's challenging. It's challenging because capital is not flowing freely, and lenders are relatively skittish. They seem to be more, impacted by economic data, a jobs number, a CPI number, a PPI number, than they are by underlying fundamentals. And everyone wants to go to the numbers and talk about, entry caps and exit rate caps. And I couldn't agree more. And so what I say to people is, look, when we're acquiring an asset, yes, it's gone from a tailwind to, either kind of neutral or a headwind when you look at the macro for acquiring or disposing of assets. But we always kind of go back to this simple concept of just look at the numbers. And that's kind of takes us back to the operation side. And it takes us back to where can we take rents? Where are we getting rents in similar assets in the same markets? How can we manage expenses? What are the controllable expenses we can optimize, try and push down without seeing any degradation in service? The expenses we can't control, what are some of the levers that we can maybe offset, or we can engage consultants to help us optimize those? And when you get down to it, we just want to look at the NOI. So what's the net operating income of this property? And can we get there? And anyone who tells me, because it's my favorite when I talk to investors and lenders and just market practitioners, I think in 5 years, I don't think that's going to be a 5% exit cap rate market. And I say, okay, well, give me the data that tells you that. Well, I don't have any data. I just don't think it's going to be there. And I said, okay, well, let's just go through and say, let's say you're right. It's not a 5% exit cap market, but instead I can grow my NOI, say 8 or 9% year over year during the next 5 years. And then I could tell you, well, I mean, maybe I'll hold it for 5 more years, or I'll refinance it and get you back all your equity. And I still have an asset that's generating free cash flow in the low single digits or even high single digits or teens numbers. And to me, what I would say to it is there are things I can control and there's things that I can't control. And when we find an asset that we like, and why do we like it? Well, because the numbers prove the case, meaning rents are below where we know we can achieve rents today and in the near future. We have boots on the ground, so we can effectuate change through our operations, meaning we have similar assets in the same market, and we know we can attract talent and we can effectuate change that way. And then we have boots on the ground as it relates to construction. So we own our own construction company. And so can we renovate units, improve amenities, and renovate exteriors? And can we do that in a cost-effective manner? If the answer is yes, and we know we can get the rents, I kind of say, I don't have a crystal ball. I wish I knew where interest rates were going to be in 2 years, 3 years, 4 years, 5 years, where exit cap rates were going to be, where investor sentiment was going to be. At the end of the day, you need a buyer of your asset. But what I can do is I can create a financing structure that gets my asset tied to my liabilities and then ultimately cash flow that asset. Then I can refinance it again. Obviously, there are periods in time. I don't have a crystal ball. Like if we go through another 2008 and the capital markets completely shut down, that's a risk. I mean, anyone who's investing with us or in this space know that there is no such thing as a risk-free return. Even in even in the fixed income market, right? I think everyone thought that treasuries are a risk-free return. Well, guess what? There's mark-to-market risk, and so as long as we're getting compensated at an appropriate level for that risk, can we then put a liability with an asset, and then ultimately roll that liability, get cash back to our investors, do that again, and maybe we need to hold it for longer. So I think when we look at the market at the top level, at the financing, disposition, acquisition, it's doesn't feel great right now. On the micro level, at the operations and the construction, and just the demand for affordable kind of multi-family shelter, it hasn't been higher. Because the thing I always also point to people is the affordability piece was the big killer during the last 2 or 3 years for single family ownership, right? Or even condo ownership. Now it's flipped on its head. Now you're seeing prices come down, but mortgage rates are at 7%. And so, it's, single family or ownership in general of shelter there's a very small window of what I would call the sweet spot where you can really take advantage of it. In multifamily, when you're talking about for rent, there are much longer periods where our asset class is a lot more attractive than, say, owning. And that's because the affordability component, the interest rate component, those things really hamper the competition of leaving our asset to go, buy your own asset. And then we're not even talking about the operating piece of owning your own home, or owning a condo. Anything from a hot water heater to air conditioning units to taxes to maintenance. I mean, it's when you add all that up, and insurance, it's very cost prohibitive for most people. And so we have a natural buyer or renter pool. I call it kind of buyer pool, but renter pool for what we do. And that, to me, even when the headwinds are strongest, it feels like we're in a neutral position versus other asset classes where you're, feeling like you got 50, 100 mile an hour gale force winds on your bow.
Yeah. And now, it sounds like there's I would say 2 general operating models when volatility or uncertainty markets happen. One is to just kind of sit on your hands and wait and see and not be proactive. But it sounds like what I'm hearing is based on your boots on the ground operational level. There's deals to be had in any market, right? It's more than just we're going to wait. Market's not favorable right now. Or are there areas at which, cause you guys are still actively pursuing deals right now, and I think we've seen some hesitation, right? Certainly from the investor side, right? Some kind of waiting and seeing and letting some of these macro factors play out. Has the current environment changed your strategy, or are you still bullish on acquiring new properties? How does that look?
Yeah. So, I think that does summarize, I think, how most people feel. I think we try and, again, let the numbers kind of dictate what we're going to do. So I try not to create selection bias. And I think when you say, hey, I'm just going to put my pencil down and I'm not going to underwrite any deals, or I'm not going to acquire anything until the Fed gets to a terminal rate, or at least shows some willingness to kind of slow down rate hikes, I think that's a mistake. And again, I think some people will listen to this and be like, no, John's wrong. This is where you just, batten down the hatches and you just ride out the storm with what you have. And I think this is one where we can both be right. I don't think there has to be someone who has to be right and someone has to be wrong. What we do instead is we underwrite every deal that comes across our desk. We do it in the current market conditions with some forecasting of the future. And the difference about us is we are just not super aggressive on the 4 or 5 levers that we can pull, whether that be rent growth, exit cap rates, expenses, operating occupancy and vacancy and bad debt. We try and be relatively conservative across all of those metrics. And we don't want to be max on any of them. Max assumption, meaning everything needs to go right for us to be successful. And I think that's afforded us a great opportunity set in the past, and I think it helps us today. And what I mean by that is you hear of people who say, oh, when this is all over, I'm going to buy everything I can find. And most of those people never buy a single thing because they've already missed that opportunity, because when there's blood in the water is when you want to start buying. And I think for us, are we buying at the same rate that we were 2 years ago? Of course not. Are we disposing and refinancing at the same rate? Of course not. But are we still underwriting deals and looking at opportunities? 100%. The team is still as active. They're still on the road. They're still in the markets. They're still doing their work. And yes, we have a couple deals that we're raising capital for now, and it is harder. I think because people are, uncertainty in their minds causes them to be more cautious. For me, uncertainty, when you can guide yourself to the outcome you want, it's not uncertainty to me. To me, it's opportunity. And so we try and take advantage of that. And our biggest thing that we tell all of our teams on the ground is just give us real data. Are we getting the rents? Are we getting the qualified traffic? Are we able to turn units? Are we able to renovate? All the things that make our business go, just give us real data and don't tell us what we want to hear. And of course, we're in all these markets. Not every market is performing the same today as it was 6 months ago or 9 months ago or 12 months ago. Some are performing better, some are performing behind, some are at market. And so you gotta underwrite it and let the numbers kind of dictate where you should go. And then I think, again, the last piece I would just say to it is, we own a hard asset, right? We own, an asset that people need. If you look at kind of what are the 1, 2, 3 things that people are going to make sure that they pay, it's their rent, their car payment, and probably getting their new iPhone. Those are, and some people might substitute the iPhone for Air Jordans or, sneakers or clothes or something. But we tend to fall in 1, 2, or 3. And our asset has another great advantage is it's got a depreciable value and it's got a great tax benefit to it. And so when you take all those things, it's got store value to it. You don't want to own cash. You don't want to have cash right now. You're losing 8% a year right now, 8.5% of the value of your purchasing power in cash. And again, some people will say, well, it's better than the stock market. Of course, yes, I'd rather lose 8% than 25% than the stock market. But we're trying to preserve and grow capital. And I think owning this hard asset will allows you to do that. And there are other hard assets you can do that with. It's not just real estate. It's not just multifamily real estate. So that's how we kind of look at every day.
And then you'd mentioned also earlier you're in a select few MSAs that you guys focus on. What are some of the higher level metrics or factors that you look at when you're either choosing the market that you're currently in, or if you're looking to expand into new markets? How do you guys take a look at that in terms of, I guess, both expanding into new markets and what has attracted you to the markets that you're currently in?
Yeah, so to add new markets, a huge hurdle for us. So in the past 3 years, we added one market. And that's because it goes back to what I said earlier, this concept of boots on the ground. So we got to be able to effectuate change from an operations perspective and a construction perspective. And the only way we can do that is boots on the ground. And so it's super hard to build construction capabilities overnight in a market and to create operations capabilities in a market overnight. And so that's a super high hurdle for us. So if we enter a new market one every 2 years, I think that's been about what we've done. That's probably what we'll be go forward. In terms of what we're looking for, it starts with the economic drivers. So we want job growth. So we want employers to want to relocate or allow their workers or their employees to base out of there. We like to have diversification if we can in our economic drivers. So we don't want to have one employer be, the entire market. I mean, there are markets where we have concentration, absolutely. For those investors who've been with us before, we are in Northwest Arkansas, and so yes, Walmart is a large employer there, but so is J.B. Hunt and Tyson Foods and all the hospitals and education and all the service-related industries that support that. But that's just one example. And so we want to have those economic drivers. We want to have, a government, municipality, local pro-business, I'd say short and medium and long-term tax-friendly. We want to make sure that we have a good education system, a good infrastructure, service center around where we're investing. And then the biggest thing is there's got to be a quality of life factor to it. Mm-hmm. So there's got to be a demand to want to live in this market and in this MSA. So for us, it can be as simple as, again, to go back to that Northwest Arkansas, #1 outdoor biking community, mountain biking in the country, right? It's got a huge demand for that. People love the outdoors there, everything from the Ozarks across, that's a great story for us. We like to have that. It could also be in Dallas, where we're located, right? Metropolitan city with great schools and, easy quality of life. Those are things that we're looking for. So I would put those things a little bit more on the qualitative factors and much more on the, economic drivers, the employment drivers, the governmental municipality drivers. Those are all things that I think ultimately, are important to us. And the last thing I would just add, because people ask us all the time, you need to be in an MSA that can actually handle the influx of what we're trying to forecast or hope happens, right? And I think, there are certain MSAs that we're not in that have a huge amount of demand, but they don't have the infrastructure and the ability to accommodate that growth. And I think those are where you can get into trouble. And so it's not just as simple as go to the zero tax states that are all on the coast that, are seeing kind of COVID population growth. There are some markets in there where, they haven't built the infrastructure or created the right environment for both residents, but also companies to afford a long-term sustainable growth model.
Mm-hmm. And then, given the environment that we're in, do any of those fundamentals change, or are you looking at any different factors where we're at today in terms of new markets you might be looking at? Or is that pretty much, I mean, those are pretty fundamental analyses that when you're looking at markets?
Yeah, they're pretty like long-tailed, right? They're not hyper volatile. I think there are instances which we haven't participated in, but I could see like a post 2008 kind of Arizona, Las Vegas kind of snapback, right? Where you could have that opportunity. I think for us, because we are so focused on this boots on the ground on operations and construction, we're making much longer term investments than just a macro that was overdone. We can, extract a 25 or 30% price appreciation. Instead, we're saying, okay, let's effectuate these longer term changes on these properties. And that requires a longer term investment, and one where we're hoping that, states like Texas and Florida and, Alabama and Arkansas will remain kind of lower tax, zero tax states and have this, 10, 20 year, economic boom from where we are today.
And then now switching, a lot of the listeners of this show are passive investors in this asset class. Maybe putting your investor hat on, what are some of the questions that you might encourage investors to ask of sponsors, of managers, when they're looking at investing with somebody new, or they're looking at a deal in a new market maybe they're not familiar with? Are there some kind of high level questions to get some comfort or get some experience or exposure to some of those bigger metrics and kind of the mind of the sponsor when they're looking at those markets?
Sure. I mean, I think this is truly relevant of whether you're, a couple of these are, whether you're talking in real estate and the multifamily side, or you're talking about any real investment. You want to make sure there's an alignment of interests. I think that's all the way from, physical dollars being contributed all the way to, how does compensation get divided up, and what are the real economic drivers of the deal for the sponsor and I think for the limited partners. But I think that goes to, are you being treated as a partner? And then when things don't go right, what's your partner's track record for supporting the deal? And because anyone who tells you that the business plan is perfectly written and there's never any hiccups is just either not invested in a lot of deals or doesn't kind of sticking their head in the sand and doesn't want to admit stuff. We're very transparent. I mean, I wish every deal went to business plan. It doesn't. It usually gets to its business plan, but the path on which it gets there is, can be one that's slightly different than what you originally underwrote, and you've got to be, as sponsor, willing to stand behind that. And ultimately, we haven't done capital calls, but other people may do that, and there's nothing wrong with capital calls. Just ultimately, what's your business plan? I think on the top level, additionally, like, what's your asset liability? I talked about this earlier. Match, and not just with your debt lenders, but with your partners. And so, if you're underwriting, a 3-year hold, you obviously have to be prepared that you may have to exit that asset before or after that 3-year period. And so you want to make sure investors are aligned with you on that. And that can be a point where you don't know what's going to happen. And so you want to make sure that you haven't put yourself into a position where a fair number of the deals we've bought that have been hugely successful for us, not even during this, what I would call more choppier period here, we've bought assets from sponsors who were forced sellers. They were forced sellers because they, had a maturity on their fund or their asset. And so, they needed more time to realize the full benefit that we were able to realize. So I think those are, alignment of interest, the asset liability mismatch, both at the partner level, but also the lender level. I think on the technical side, I think it's a little bit of what I said before, which is, how many things need to go right for this to be at or above business plan, to be within a standard deviation of the business plan, to be within 50% of the business plan. And I would just say if you need everything to go right to get to the business plan, that to me is, as a personal investment, if I was making that, would make me a little less comfortable or less comfortable. But if you've got some levers to pull, okay, well, we can be more aggressive on the rents because we were wrong. We underwrote 6% or 7% rent growth and the market's getting 20. Of course, we knew they were getting 20. It's not like we didn't know that. It's just that, do you need to underwrite 20% to make the deal work? Or are there cost savings that you could get in construction if you value engineer ABC? That type of stuff. So I would tell people to, dive down into that. I think the other big thing is, tell me about your mistakes you've made. Tell me about the lessons learned, how that shaped you as an investor, how that had shaped you as a sponsor, as an operator. Those, I think, are super important things.
Yeah, I agree. Well, John, that's a fantastic overview of what you guys are seeing right now on the markets. As we wrap up here, why don't you tell us, a couple questions I always ask, when you're thinking about the multifamily space or just generally real estate right now, what are some of the things that keep you up at night?
Yeah, so I mean, part of being the CEO is I'm also kind of the head risk person, right? So in this industry, we don't have like a chief risk officer, but that's my job, right? I'm supposed to have the sleepless nights because I'm supposed to think of the things that could go wrong. And so, I think my list of things that I think about are no different today, or the length is no different today than it would have been a year ago, right? A year ago, I'm sitting there saying rates can't be this low forever. Or I'm saying our, competition for talent on the construction side and the operation side is so fierce that we can't actually get the boots on the ground we want. And now you fast forward 12 months and rates are higher. So now I'm thinking, well, what is the terminal rate? Are terminal rates, going to be in the high single digits or the low teens? Or are terminal rates going to get, somewhere above 5, and then we're going to be in a recession? And then, how do we think about operating our assets in a recessionary environment versus an economic growth environment? Also knowing that we operated our assets in a pandemic, which is far worse than any recession I've ever been a part, and that includes '08. So, I think there are lots of things I think about today. Like I said, the terminal rate of rates, the buyer pool of assets, the ability of lenders to continue to want to provide capital. Those are all things I think about, but at the same time, I'm also a half full guy, not a half empty guy. And so I also think like, wow, this is a great opportunity for us to, go and acquire more talent and grow our ranks in operations and in construction and on the acquisition side and the capital market side and technology, right? Because, as you hear Goldman Sachs laying off X number of people and Blackstone doing this, everyone, no one wants to be the last person to lay people off. We don't look at the world that way. I think we look at it as do we always have the right people sitting in the right seats on the bus? And ultimately, can we upgrade our talent pool or expand our talent pool? And so those are the things I spend most of my time thinking about. So some are risks, some are opportunities. Are there asset classes we're not in that we could take advantage of? Ground up development or value add on office space. I mean, there's so many things that I think about. I try and get a good night's sleep, but ultimately, it is one of those things where you can control what you can control, and then you can prepare yourself as best you can, and then you got to ultimately kind of play the cards you've been given.
Yeah, I think to your list of things not really ever changing, that's been my personal mantras, and one of my learnings as CEO as well. It doesn't ever get any easier; it just gets different, right? There's always going to be a list of concerns, but I agree with you completely. Control what you can, and try to have best information you can to make decisions on those that you can't control. So you kind of touched on some of the optimistic points there. Anything else that you're looking forward to, or where you maybe see some opportunities, given current market conditions and where you see things going?
Yeah, the last thing I would say is I think we truly do believe there will be an opportunity to take advantage of other people's missteps, but we don't hope that on anyone. But ultimately, we want to be prepared, and I think that's again where we're investing our capital in terms of our team's development. Continue to just kind of pay it forward so that we are prepared. If in 6 months the terminal rate is 6% and people can't, meet their debt payments, we want to be in a position to take advantage of those. Mm-hmm. I think it'll be hard at that point because people will say like, "Oh, you're paying a 6 cap here and rates are at 6%. Is that really?" But maybe before that asset was a 4 cap. So now it's 50% cheaper in theory. It's always hard to convince people in that storm to step up. But I think other than that, we're kind of keeping our heads down and making sure we're taking care of our business, and kind of see what pitches get thrown at our way and what we're going to swing at. And just want to be selective.
Perfect. Well, that's a great spot to wrap up, John. Why don't you let the listeners know how they can learn more about what you're up to at LURIN?
Sure, yeah. So obviously encourage you to take a look at our website. It's lurin.com. And then obviously, we are active in the market on a number of different platforms. And so, encourage people to take a look at our progress as we kind of go through this next period in the multifamily market.
Perfect. Well, John, thank you again for sharing your thoughts with us today. Really appreciate you coming on the show.
Thank you. Appreciate it.
All right, listeners, as always, if you have any comments or questions, please send us a note to podcast@realcrowd.com. And with that, we'll catch you in the next one.